So you're looking for a mortgage, are you? Well, they're not all created the same. We're going to explain here in this video the 3 most impactful tips that I can pass along that'll save you thousands, that'll also reduce the confusion, and that'll cut through all the malarkey, as my father used to say, of getting the best deal in the mortgage market. So it all centers around 3 different concepts. We're going to talk about each one individually, do a deep dive. We're going to talk about credit, your credit scores, that is, more exactly. We're going to talk about financing techniques, and we're going to talk about the lender themselves, who you choose as a lender. Those are the 3 areas we're going to dive into. Let's start that right away. My name is Kevin Fagan. I'm with NEXA Mortgage. I've been doing mortgages now for about almost 20 years, gosh. And really enjoy it. Love to see a client really feel like they've got the best deal. I feel like I've done my job when they walk away very satisfied. We've made got a great rate when we've given them a smooth transition through the loan process, and now they're in the home that they've always wanted. So let's go to number 1, credit and credit scores. The single biggest impact you can make to getting a great rate or getting the lowest rate is your credit score. Just that simple. That's nothing new here, no big secret. But let's do a deep dive. So the higher your credit score, right, the lower your interest rate, because the lender is looking at you and they have a matrix typically, and they'll say, from 620 to 640, we're going to give you such and such, from 640 to 680, from 680 to 720, from 720 to 760, and 760 and beyond. So each strata, each bracket kind of really gives you better, slightly better pricing. To have a score over 800 is great, but there's no reason to sweat, 790 to 800, for example. Anything above a 760, that's really much topping out in terms of the pricing. So in other words, if somebody had a 761 versus an 800 or an 830 score, which would be tremendous, their pricing is the same. Anything above 760, I like to say, is just bragging rights. So don't sweat it. If if you think you've fallen below 800 to 795, it's not going to hurt your pricing. Okay, so back to the pricing. So what does it all translate to in terms of how much you can save? Here we show an example of what the impact of, say, going from 680 to 740 means for you in terms of dollars saved. Right now in the market, a 680 score gives you about a 6.375 interest rate. But if you were to get your score from 680 to 740, instead of 6.375, you're looking at 6%. So what does that mean for you in terms of a 30-year savings? You're saving more than $27,000 over the course of your mortgage. So that's like a new car. If I said to you, hey, I can get your score from 680 to 740, and I'll throw in a new car along the way, I think you'd perk up a little bit. So let's look at the ways that you can improve your credit score, because again, that's what it all comes down to. I personally can give you quite a bit of very, very good information that you're going to want and need, and it'll be actionable, meaning you can use it right away without spending money to take your score from 580 to 620, 620 to 680, 680 to 740 or above. So if you're interested, please do a couple things for me. Like and, of course, subscribe, please, to the channel, because that helps me out and it helps you out. So like and subscribe, but put comments below, please. Put your email and say, yes, please send me your credit score tips. And I'll send you a little printout. It's going to really help you, especially a couple of the last ones. One is so dramatic, it's really a super booster of credit scores. So again, I have a little simulator. It's a credit score simulator. I enter everything in the simulator and it'll tell me what actions you have to do to get your score to a certain level. And all it would take is maybe to pay off a credit card or pay down a credit card. It actually figures it out for you. I send you that action step report, and then it shows you a probability of getting to that score that you desire. So it's a great service. It's complimentary. I don't charge for that, but that's one way that you can increase your credit scores without having to pay the so-called professionals. But if you do have to pay the so-called professionals, please, please, please invest in yourself to do so. In the mortgage world, it's a mathematical equation. It's a mathematical certainty that if you get from 680 to 740 and your price improves by 0.5%, you're going to save $50,000 over the course of the mortgage. I can prove that with a simple amortization chart. Don't cheat yourself. Invest in the process of improving your credit score. Okay, so that's number one, credit score. Let's go to number two, financing techniques. What am I talking about? The mortgage broker like myself will be able to help you with this. We're talking about buy downs. You probably heard it in terms of a discount point. So what are we doing? We're buying down the rate. So that's why I call it the buy down. In a buy down scenario, there's two different scenarios I want to concentrate on. One is very popular right now. It's called the 2-1 buy down. You're about to start the loan process and you're getting locked in at 6%. You can do a 2-1 buy down. And what does that mean? The first year, you get 2% off that 6%. So your first year payments are going to be based on 4%. And what's the 2-1? The second year, you get a 5%, 1% lower than the 6%. So if your base rate is 6%, your first year is 4%, your second year is 5%, and your third year goes to 6% for the remaining 28 years. What's so great about that? Well, in the first year, your savings on a $300,000 loan could be $250. Saves you quite a bit of money. Second year, your savings are about half that, about $125. If you're barely qualifying and you feel like it's a 6% is a tough rate to handle in the first couple of years, but you know that your salary is going to increase over the next 2 to 3 years, then a 2-1 buy down is a good alternative for you because you're getting in at a much lower rate. Does it cost money? Yes, it costs money, but we'll go over that in a second. Okay. Second type of buy down is the permanent buy down. What does that mean? Well, just like the name implies, you're permanently buying down your rate for the entire length of the mortgage. The 2-1 buy down, it only lasts for the first year and the second year. So the permanent buy down does cost more because you're buying it down for the entire length of the mortgage. How does that work? Let me show you. So here in our example, where you're going to not just enjoy 6%, you're going to really enjoy 4.75. What does that cost? Well, in my example, we're going to say it costs about $12,000. So look at the difference in the numbers. Over the 30 years, how much you save. As our friend and the late, great Chris Farley would say, holy shnikes. I mean, you're saving in the first example from 6.375 to 6, you're saving about $27,000 like we talked about before. But now look at the savings at 4.75 for the entire length of the mortgage. You're saving over $100,000. That's a big deal on a cost of about 12. Now, who actually pays for that discount? Who pays for the buying down of a rate? There's only two sides to the equation here. You have the buyer and the seller. You'd rather have, of course, the seller pay for this. So we're going to talk about seller concessions now because the market is starting to soften. There's more negotiation in any price of a house. So let's say, again, you're looking for a $330,000 house and your mortgage is going to be around $300,000. If they're asking $330,000 for the house, and rather than come in and say, I'll give you $320,000 for it, you can say, let's keep it at $330,000. But in the contract, you write seller concessions of $10,000. So the price stays the same as $330,000, but now the seller is conceding back to you $10,000. And what do you do with that $10,000? You use it to buy down your rate. So seller concessions speak to the heart of how you want to use financing techniques like these, like a 2-1 buy down or a permanent buy down. So that's the second one. The first one was credit. Now we talked about financing techniques. Let's talk about the last pro tip I can give you, and that's choosing the lender themselves. First, let's talk about what is a lender versus what is a mortgage broker. I, for example, am a mortgage broker. The lender is the institution the money comes from. I'll say that again. The lender is the institution that money comes from. When you're dealing with a mortgage broker like myself, the money doesn't come from our institution. So why would you go with a mortgage broker? Because we shop lenders for you. And I'll explain that for a second. So going back to the lender, I'll say this. Friends don't let friends shop at the big banks or direct lenders themselves. Why? Because friends know that the lender can only give you their own product. A big bank like Wells Fargo, Chase, Bank of America, Citibank, these types of institutions can only give you, Chase can only give you Chase's products. It only makes sense, right? You go to McDonald's, they can only give you a McDonald's burger. They can't give you a Wendy's burger or a Fuddrucker burger. But imagine somebody that can shop mortgages across all the lenders. You don't want to go to a direct lender that can only give you their own products, because what if they don't have the best product at the time? Or what if their rates just aren't very good? They're going to tell you, of course they are. But as a mortgage broker, we have a platform that we shop over 100 different lenders across the country. So our institution has agreements with each one of these lenders that you're seeing in this page here, and we can find the best lender that has the best rate at the time. So let me, as a mortgage broker, do all the heavy lifting for you. Don't take on the shopping effort by yourself. You'll drive yourself crazy and others around you, because you'll be susceptible to every marketing gimmick in the country. As you drive down the street and see such and such bank is offering $5,000 of closing cost coverage, or we can give you 2.5 on the first year. These are all total gimmicks until they lock that loan and show you a loan estimate of all their itemized costs. That's what a loan estimate does. It shows you all the different costs from the lender and everybody else for that matter. You don't have anything. Do not accept anybody's word. Do not accept a billboard telling you you can get X amount of closing costs for free. Do not accept a builder telling you, well, we've got incentives, you use our lender. These are all incredible manipulation until you get a loan estimate, which I give you, and I outline all the fees, and you get a locked loan. You have nothing. I used to work for a direct lender, so I know. We would get loan estimates from other people that were shopping around. They'd show us a loan estimate from Loan Depot. We'd smile because we knew all we had to do was ask for the loan estimate and we would crush it, because Loan Depot packs some heavy duty fees in this loan estimates. And some people just don't know. They've never been helped out to the level that I can help you. Walk through that loan estimate and you see $3,000, $5,000. I've seen $11,000 in a loan estimate from this institution that was totally unnecessary. And we were able to, of course, get those people out of those deals. So even if you started a loan and you're starting to feel something's just not working right, or you feel like, you're kind of getting scammed, you can send the loan estimate to me and I will present a loan estimate so you can do apples and apples to see what the rate is, a locked rate on my side, a locked rate on their side, and see exactly those fees, how they match against each other. So you want to go with somebody who can shop for you. That's not a direct lender, that's a broker like myself. And you want to get your credit scores, I can help you with that, as well as using financing techniques to buy down your rate. Those are the three ways that are going to assure you get the best deal in town. Schedule a time with me, please. Call me, text me, email me, whatever you want to do. And let's get together, spend 5 or 10 minutes in a discovery call, and I'll walk you through getting the best deal you could possibly imagine. My name is Kevin Fagan, and thank you for watching this video.